Hello and welcome to today's Market Matters video update. I'm Harry Watt, joined by James Gerrish. It is the 4th of December. We're going to talk about some positioning, some performance figures, where the market is heading into Christmas, James. So kicking things off with the Market Matters portfolios in November. Equity markets rebounded a little bit after a pretty soggy couple of months leading into it. How did the Market Matters portfolios stack up in that period and sort of over a medium-term time frame as well?
Yeah, they rebounded really strongly in terms of the market more broadly. So if you think of the 2 months prior to November, the market fell more than 7% here in Australia, and has rebounded about 5% in November. So a really strong backdrop for equities in the month just gone. It was all on the back of interest rates, bond yield expectations that global central banks are now done in terms of interest rate hikes, and the market is staying at price and interest rate cuts in 2024, particularly in other parts of in other areas of the globe, not so much here in Australia, but in other parts of the globe. So that provided a really supportive backdrop for equities. So the ASX 200 accumulation index, so inclusive of dividends, was up 5.03% in the month of November. The active growth portfolio did 5.1%. If I look a little bit longer term, so calendar year to date, that portfolio is up 14.37%. About 9.5% above its benchmark, so that's tracking along really nicely. And then if you think about inception, so from May of 2016, it's up 13.3%, which is about 5% above its benchmark. So tracking pretty much where we want it to be, Harry. The income portfolio, it's a little bit more of a defensive portfolio. It's not going to experience the strong moves that the underlying market does in their entirety. So it's about 50% equities, about 50% fixed income type securities. It was up 2.06% in November versus its benchmark, which was up 60%. That's a cash plus 4% benchmark. If you think about calendar year to date, it's up 5.66%, slightly below its benchmark, but in inception to date, it's up 7.87% per annum against its benchmark, which is up 5%, so 2.8% outperformance per annum versus benchmark. International equities were stronger than what we experienced here in Australia. What we benchmarked the international equities portfolio off the MSCI Global World Index in Australian dollar terms. So obviously the Aussie dollar was strong during the month of November. The benchmark was up 4.44%. Our international equities portfolio put on 4.5%. Inception to date, it's up 15.73% per annum, about 5% above its benchmark, so tracking along well there. And the emerging companies portfolio, our high risk, high reward approach to smaller companies on the ASX, it put on 6.25%, slightly below its benchmark of 7.04%. Inception to date, it's up 4.09% per annum, about 3.5% above its benchmark. Noting the inception of that portfolio was just prior to the pandemic, so we wore a lot of pain at the outset of that portfolio. So, sitting here, we've written a lot about it in Market Matters reports. We're bullish into the back end of the year, and our portfolio is positioned for that. We've got low cash levels and really, positioned for that Christmas rally we've been writing about.
All right, getting onto that Christmas rally, like you said, portfolios are positioned pretty, fully invested at the moment, pretty low cash balances across the board. That's part of, our sort of positioning and our stance into this rally that we're expecting into Christmas. So what sort of sectors are we long and what sort of sectors are we probably a bit short in at the moment across our portfolios?
So just from the things that we like at commodities here, pretty much across the board. So copper is one I'd call out. We've got copper positions right across the Market Matters portfolios. We're bullish on that. Gold is another one we're overweight in, so this is predicated on US dollar weakness. So the change in bond market, so yields lower, is also bearish for the US dollar, and that is bullish for gold. So we've got some nice positions in gold that have been doing well in recent times. Technology, we're overweight in that space in our active growth portfolio and our international equities portfolio. We're probably a little bit more cautious at this junction around that. So they've had phenomenal runs. A lot of the tech companies, the tech indices have been the real shining light over the past 12 months. So we're probably a little bit more reticent to go out there and take on new positions, and probably more on the side of trimming those positions that we do have into strength. And then other areas we like here are property, real estate. They've had a really difficult couple of years. They're starting to show some promise, I think. And I think that'll be a sector that will do pretty well in 2024, and we're positioned that way for it, Harry.
All right, I want to bow you up here on the consumer sector side because you didn't touch on that at all in your little rant there, James. But the staples, we've had Metcash to kick off the week in terms of their first half report. We've had some little snippets of data and some AGMs in the last couple of weeks that maybe suggest that the consumer sectors are holding up a little bit better than it hoped. We don't have a great deal of exposure across that space. Is that something we'd add to, or is that something we're sort of happy to sit back on the sidelines for now?
You're right. We don't have a lot of consumer exposure. We've got Metcash in our income portfolio. We've got Premier Investments in our emerging companies portfolio. International equities, we've got a cracking position in Chipotle, CMG. That's done really well for us. And we've got a couple of other positions, Brunswick, and I'm probably forgetting
Yeti.
One or two, Yeti, which has been a really phenomenal one, which is apparently I've asked Santa for a new Yeti this year. And my youngest daughter, who's 10, I said that they're really expensive, and she has put it on her Christmas list for Santa to buy. So fingers crossed, Santa brings me a Yeti for the boat this Christmas. But that's been a great holding for us. I think Metcash reported numbers today that were pretty solid, slightly better than the market expected. My concern is around the lag effect of rising interest rates. And the lag effect has been longer because savings rates have been high, savings buffers have been high. So I go into 2024 probably a little bit more not outright bullish on the consumer, Harry. So I think interest rate, whilst bond markets are pricing interest rate cuts, I think we're not there yet. We're still seeing this. I think we're about to see a more pronounced impact on the household balance sheet, which is going to be negative for retail. So we've probably been a little bit wrong on the sector so far. So take that with a grain of salt. But I'm not going into 2024 bullish on the consumer by any stretch.
All right. Well, that's all we got time for today. This is the last time we're going to sit in front of the camera in this format this year. We do have a webinar coming up this week, so one to watch out for on the Market Matters website. But for now, that's all we got time for. So I'd like to extend a very warm and happy Christmas and New Year's to all our subscribers out there. I hope you've enjoyed 2023. We've got a big 2024 planned as well for subscribers, so we really look forward to that and joining you in the new year.
Yeah, Merry Christmas to all our viewers out there. It's been a huge year for Market Matters, really. So we've grown significantly this year. We've added features onto the platform. Portfolios have been going particularly well this calendar year to date. So all's looking good for a happy Christmas and a prosperous 2024. So thanks for watching. Speak to you soon. Bye for now.